Here with Peter Orszag. Welcome, Peter, to the Global Energy Symposium. I wanted to start with some initials: PhD, CBO, OMB, CEO. So the PhD is in economics from London School of Economics. Peter was head of the Congressional Budget Office. He was head of the Office of Management and Budget. And now he's head of Lazard, which is not only one of the most venerable, but one of the most prominent and important investment banks. So he brings a lot of perspective. And Peter, I'd like to start with where you've been. You've been in Europe in the last week. You've been in California. What you're hearing about the turmoil we are in, and of course the turmoil changed about 2 hours ago somewhat, but for those who haven't noticed, the reciprocal tariffs have been postponed for 90 days. And then how it looks to you as a banker, talking to companies about their reaction, and then putting on your hat as a PhD economist and just telling us what's right and wrong. So
okay,
let's start with the tour.
Well, you left out the most important background piece of information, which is Jason Bordoff, you and I were all Marshall Scholars. Yes. So we have that special bond. So I'm very pleased to be with all of you. And I'm really, really excited to see what Jason and others have built in this center. So that's that. Look, on the tariffs, it is really interesting to go back and read an analysis by Stephen Moran, who is the chair of the Council of Economic Advisors, from November of 2024. It's on the web. You can go to Hudson Bay Capital, which is where he used to work, called A User's Guide to Reorienting the World Trading System, in which he lays out the theory of the case for what the Trump administration is now doing. And I have a different perspective on that theory of the case, but it is a theory of the case. However, in it, he points out the very substantial risk of economic and market volatility if this is not implemented in the right way, and repeats that tariff changes of the magnitude that he was discussing, if not implemented in the right way, could cause severe market volatility. And when he said implemented in the right way, he specifically said incremental, in other words, done step by step, and with what he called forward guidance. That means announced well ahead of time. So you announce that over the next 2 or 3 years, tariffs are going to go up bit by bit.
And that's exactly what's happened.
And what I was getting to is that's not what happened. I think what's happened, over the past week is a severe reaction to the opposite of that, to things being announced effective immediately with a small lag in a matter of days, not even weeks or months, and a very large increase. And then also questions about the methodology and the kind of the theory of the case behind the specific tariff rates.
So you jumped ahead to wearing your PhD hat on that. First, just for the benefit of the audience, is the paper easy or hard to read?
Oh, easy, especially if you use ChatGPT.
Okay.
So where we are now is, I think effectively what's happened is a reversion back to what one hopes is a more methodical process here. And I think that's partly because the market reaction, markets don't like uncertainty, and markets don't like sudden big moves, which is exactly why Chair Moran laid out that you do it slowly and you do it with lots of advance warning.
But so as an economist, we're skipping ahead back to your economist, is what they're doing on tariffs, does it make sense to you?
It's not what I would do, but I think you need to understand, we all need to appreciate that there is a deep level of frustration with the economic experience that many Americans have had over the past couple of decades. And the way I like to think about it is, if for 2/3 of the American public, 2/3 of the American public has had flat to declining life expectancy over the past 2 decades. Just pause and think about that. Average life expectancy pre-COVID went up only because at the top of the socioeconomic distribution, there was such a rapid explosion in life expectancy and reduction in mortality that average life expectancy went up. But the gap between higher earner, better educated people and lower earner, less educated people was exploding. that causes a lot of frustration. And so what is the output of that, or how does that manifest itself? It's either in the direction that the Trump administration is taking, in which the problem is international trade, or the alternative is laid out in the new book by Ezra Klein and Derek Thompson in Abundance, which is on the Democratic side, there's been a lot of attention paid to subsidizing demand and not a lot of attention paid to expanding supply. So the result of that is lots of subsidies for housing, not a lot of expansion of housing supply or capacity. What happens? Housing prices go way up and you create an affordability issue, and so on.
So we're going to come back to the reactions you're hearing around the world, but since you mentioned that, and Ezra Klein, they also criticize, and it's become part of the Democratic vocabulary, and I think Jake did it implicitly, neoliberalism. You were part of neoliberalism. What is neoliberalism and what's wrong with it?
Well, what I would say is neoliberalism has a little bit of fuzzy boundaries. I instead call it Econ 101, which is the Washington consensus that was dominant for a long period of time of effectively unfettered free markets.
Well, it wasn't really unfettered. I mean, there's heavily regulated.
There's a caricature. I mean, the point is, in Econ 101, you're starting from the presumption that markets generally work, that free trade is generally a good thing, that the market can solve problems, and the government should be reserved for the classic things like public goods and externalities. And I think, coming back to the point I just made, that was always a caricature. We never actually did that. But nonetheless, that was, again, it was called the Washington Consensus for a reason. That was the overlay of most of the economic policy for the past couple of decades. And it did not deliver the results that a large share of the Americans want. So there needs to be some new thinking. And I think part of the problem that we face today is the intellectual case for the caricature, for the Econ 101 approach, that's been discredited, but nothing coherent has come to replace it. And so we're at this moment where there's no new theory of the case. Okay, I don't like that, but what am I doing? And so people are grasping for solutions, and that may be one interpretation of what's happened over the past week. I would say it's probably what happened, in fairness, under the Biden administration too, which is despite Jake's and other attempts to lay out a kind of framework, there was nothing that really kind of fully hung together. And so it felt like it was...
So there's still an intellectual vacuum.
There is an intellectual vacuum. So anyone at Columbia who wants to fill that intellectual vacuum, that would be a very, very significant public service.
And I do want to point out that Peter speaks with authority about Econ 101 because he used to teach it.
I did, yes.
So he's very familiar with it.
Yeah.
But tell us now, you've talked to a lot of people in Europe. You talk to CEOs here, you're on the phone as a banker, hearing from people. Maybe the last 2 hours things have changed, but what have you been hearing in terms of the reaction to this kind of volcanic eruption that we're seeing?
Look, the private reaction was mirroring the public markets reaction, which is markets and business leaders don't like uncertainty. The issue was severalfold. I think, it wasn't clear that the tariffs that had been put forward on that chart were actually the worst case scenario, because the administration was saying that if someone retaliates against us, the tariffs could go up. And in fact, that's exactly what's happened with regard to China. So you couldn't say, the way that Secretary Besson has now said as of an hour or two ago, don't worry, that's the worst case scenario. I'm not entirely sure yet how saying that's the worst case scenario and simultaneously saying we're going to retaliate against other countries if they retaliate against us, kind of how that fits together, but we will see. But that was one problem. The second problem is the variation in the tariff rates was very large. And so there are implementation issues that come because you're creating tons of incentive to transship. If you're in a country with a 40% tariff and right next door there's someone with a 10% tariff, you will want to route everything through that intermediary country, which means you're then going to have a much more intrusive monitoring system than exists in most cases. So just implementation was challenging, and the list goes on.
So that means actually hiring more people to stand there at the border and check things.
If that's what you did, yes.
So tell us, though, particularly in Europe, I mean, this isn't just about tariffs. There are other things going on, NATO, Greenland, Ukraine. Just what you're hearing from business people
well, that's the other interesting part. So I was at the Ambrosetti conference, which is a leading European business conference in Italy on Thursday and Friday. And if one of the purposes here was to encourage foreign direct investment into the US, which by the way is a logical response. If the US puts up tariffs, it will make sense to try to locate your plant or your activity inside the tariff wall as one potential response. So you have that effect. But there's also, I don't know, the operating environment seems really uncertain. My government's pressuring me not to do that, as you've seen from President Macron of France and others. And so it wasn't at all clear as of the last few days whether the net effect of what was going on was actually to encourage investment into the United States or for foreign investors to step back. And I think one of the other things that people have been watching is a little bit of tremors in the Treasury market. And just to pause on that for a second, even I, as a former budget director with all those initials, had kind of gotten sick of the worry wart, oh my God, the fiscal trajectory's unstable and unsustainable. And, it was the boy who cried wolf a little too much. And I was one of the boys who had cried wolf, 15 years ago. But I stopped doing it and I kind of zoned this out. I think we need to now be concerned about our fiscal trajectory again. The deficit now is 6 to 7% of GDP, twice what it was a decade ago. Debt as a share of the economy is a third higher than it was a decade ago.
And it's bigger than GDP.
And it depending on how you measure it, it's bigger than GDP. If not, it's going to get there really quickly. Interest rates are higher. And foreign creditors own $9 trillion of US debt. So there were some emergent tremors that may have been caused by people needing to cover the losses that they were experiencing in the stock market. That's one explanation. But another potential explanation was foreign investors starting to get a little bit nervous about the risk-free asset, the US Treasury bond. And I think it's worth, again, coming back to the intellectual framework that Stephen Rand put forward, because what's interesting in that piece, and he repeated it 2 or 3 days ago, is some ambiguity about whether the administration wants the United States to have the so-called exorbitant privilege of being the reserve currency to the rest of the world. This is a intellectual debate to have. I have always believed that it was to our enormous benefit to be in that position, which is why it was called the exorbitant privilege. But there is a case being put out that what the effect of that is that as the reserve currency provider, you need to provide dollars to the rest of the world. It's called the Triffin dilemma. And the result of that is that you've got to run current account deficits, and also your exchange rate is boosted by demand for your currency. And do we really want that?
Right. So let me ask you just a couple more economic questions before we turn to this other question that's been on the agenda all day, energy transition. When you're on the phone with US investors, do you find them jumping at the opportunity to invest in new factories in the United States in this environment?
No, I think the other thing going on is business decisions were basically on hold because of the level of uncertainty. And that was in call after call after call. And I think, again, I go back to it's not just investors, but boards and CEOs. They want to know, okay, worst case, it's this, maybe it'll be a little better. And they weren't able to kind of have that grounding. And so everyone was just saying, let's just wait and see. And the problem with that is if we had continued on the same course with that elevated level of uncertainty, that's a recipe for economic distress, because when businesses stop making decisions, things stop moving forward. Investments are not made.
You said distress, not recession.
I said that on purpose, yeah.
Okay, distress. There's that sigh of relief at the 90-day pause, but there is, on the other hand, intensifying economic warfare in effect, or not in effect, in reality between US and China. Just your thoughts on the risks there.
Well, look, I think this was, what's interesting is, I said this publicly a couple weeks ago, so I'm repeating myself, but I think people understand, maybe not at these levels, but a different dynamic with China. What was befuddling or what was puzzling people, in fact, I said it at maybe a conference that you were holding, was that with regard to Canada, Mexico, and Europe, what are we doing? What's the theory of the case for what we're accomplishing? So one thing that appears to be the result of where we are now with the pause, except for China, is we may be back in the mode of, is there a more global alignment trying to de-risk or isolate China? Because the only way you're going to succeed in doing that is if you've got, especially the United States and Europe together, a super bloc of the US and Europe united is much more of a throw weight in any attempt to change the dynamic with China than one in which the US is taking on the entire world at the same time.
Right. But I'm struck by the degree to which, with these tariffs, people just don't understand how integrated our two economies are. How many people here take vitamin C? Raise your hands. Well, quite a lot of you. I mean, 90% of our vitamin C comes from China. Now it will cost, your vitamin C will cost twice as much. I mean, it's really disruptive.
Might not be the best example. Instead of 10 cents, nobody.
Okay.
But there are other examples.
Or TikTok, yeah. But it brings it home that, just how integrated we are. Well, let me turn to energy transition. Atul Arya, who's here, my colleague, and you and I, as many of you know, have an article in the current issue of Foreign Affairs called The Troubled Energy Transition. And just to ask you from your viewpoint, what led you, I know what led us to focus on it, but what led you to think of it as something that needed to be addressed? Because I remember I heard you speak at a dinner about it, and I was so struck by how aligned we were in terms of looking at this issue.
Look, I think what is the reason I love being at Lazard is the hallmark of Lazard is to try to think a step ahead if you can and focus on some of the underlying tectonic plates and the fundamental drivers of economic activity. And there's no question that the energy transition is one of those underlying fundamental drivers, A. And B, I always find it fascinating when the public debate seems to be divorced from either untethered from reality or untethered from a scientific field or untethered from other domains where there's just a disconnect. And so it was the combination, A, really important, and B, I'm going to use a phrasing that Dan doesn't like. I had seen too much of what I call the myth of the immaculate transition, that it could just kind of
say it again so everybody can hear it.
The myth of the immaculate transition, that it could just happen spontaneously and cost-free and overnight, which was just incompatible with the fact that aluminum and steel and plastics and cement, every other fixture of modern society has deeply embedded fossil fuels as part of it, and the green premium associated with moving away from those fossil fuels embedded in all those core foundations of modern society, the green premiums were still rather large. So that there was a disconnect between saying this is going to be easy and fast and the reality of where the technology was and how deeply embedded, kind of one layer down, fossil fuels were throughout modern society.
Yeah, I think what influenced me in looking at it was actually looking at it, call myself an economic historian, looking at, well, okay, what do we know about energy transitions? And, we dated starting in January of 1709, the energy transition, and how long it took, and then looking at the scale and the size of what the economy is. And it also led to this notion, at least, which I think we all came to the same view, that what you call the immaculate transition was this linear view of a graph that just goes from here to 2050 and gets to where you want to go, and then noticing that 45% of the emissions come from countries that don't have 2050 goals. And secondly, that the things that needed to get like a rapidly growing hydrogen industry just were not happening. And it so led to this view of what we called a multidimensional energy transition that would unfold at different rates in different regions with different mixes of technology. And the other key thing, with different priorities, which was priorities in developing countries are different from priorities in developed countries whose per capita incomes are 20 or 30 times greater. So I think that sort of shaped.
And it was really fun to collaborate. I mean, the biggest takeaway that most people that I know took from this was that so far it's been an energy addition instead of a transition, that we've added renewables. The cost of renewables have come way down, but we have not reduced the absolute level of fossil fuels in the energy mix.
And you could see it in 2024, wind and solar, which are obviously well-established industries, grew, but so did oil and coal. And the only reason gas didn't grow was because of the disruptions that came from the gas market as a result of Russia's invasion of Ukraine. So that's what stood out. What have you found the reaction to the article?
My favorite reaction is my son is a senior in college and was in some discussion with someone they were debating something, and they said, well, that's not true. It's been an energy addition rather than transition. And my son, not knowing, no one made the connection, said, well, where did you read that? What's your site for that? And the person said Foreign Affairs, and someone else at the table said, oh, those authors don't know what they're talking about.
Okay. So take that as you want. But we did, I would say, every word of that article we went over many times to try and get the right balance. And we didn't really, at the end, there's not a clear solution because there'll be different solutions in different parts of the world. And energy costs, big debate about what causes the energy costs. So a couple of questions have come up. One, you publish, or Lazard publishes, it's a widely read annual analysis of levelized cost of electricity. Anything new on that?
Yeah, look, levelized cost of energy. And there are now new ones on the levelized cost of hydrogen, et cetera. I mean, the broad story is, as you know, and as other sources have documented, there's been a dramatic reduction in the cost of renewable energy, 90% or so, for solar and wind over the past decade or more. I would say over the past year or two, looking at the distribution of those costs, maybe a little bit of upward pressure based on supply chains in some forms of renewable power. But the mega story is dramatic reduction in the cost of renewables as technologies have improved. Now, back to the previous discussion, also a lot of dependence on China for a lot of the inputs into those technologies.
Well, that's what I was going to come to, because if you have economic warfare between the United States and China, and we'll say we're Europe, I mean, China really does dominate the new, and Xi Jinping called it the new industrial supply chains. And so the energy transition kind of collides with geopolitics.
Something that I think we pointed out in the article.
Right, and I would say it's become more severe since we went to print. And so, what will be the effect on, solar costs are very low because China has this massive supply system to supply it, and what happens if you have double tariffs on it? Well, one of the people here wants to go back to the critique of Jason Furman that Jake referred to about Bidenomics and the idea we overstimulate and cause inflation. Those on the other side in support of the Biden approach note the U.S. recovery was stronger than most other OECD countries. But you have noted that the economy was running too hot, including massive debt. So the question is, what do you think is more right?
Oh, I think the argument that inflation was mostly caused by the fiscal relief from the Biden administration is deeply misleading. I'm not saying that there wasn't any impact, but it was the small minority. And I think it's I don't think it has to be that complicated. Inflation went up and down basically at approximately the same rate globally across countries that had vastly different fiscal responses to the COVID crisis. That should just immediately tell you that there was something else big going on, because if it was primarily caused by fiscal stimulus, you should see significant differentials across the countries that did more versus less, point one. Point two is, underneath that theory of the case is that it was massive expansion of demand that caused inflation. And if that were what happened on the way up, then what should have happened on the way down, and various economists who are friends of mine predicted that what would happen is unemployment would have to come way up in order to bring inflation down, because if demand caused the inflation, then you have to wring demand out of the economy to bring inflation down, and that causes a big increase in the unemployment rate. Well, inflation has come way down with basically no increase in the unemployment rate. That should further reinforce the skepticism that it was primarily the fiscal relief. And then finally, I've done some empirical work with Robin Brooks of Brookings. And again, I think if you told me it was 20% the fiscal relief or 15%, okay. But a lot of the rhetoric suggests it was 90% the fiscal relief, and I just don't think that's accurate.
Right. One of the other things we talked about in the article was the degree to which AI, which began the conference this morning, has changed the trajectory on energy because of the need for electricity and how that electricity is going to be generated. Would like you to talk about that and just the degree to which Lazard has looked at the question of electricity, wind and solar versus natural gas, or as we even heard from the president, what he called beautiful coal, along with beautiful tariffs.
I think AI will raise demand for energy production. It's not shocking. It is possible that the degree to which the additional generation is being exaggerated, in part because, I mean, fundamentally, we have not really designed the chips that are being deployed for AI for the purpose of AI. They were designed for other purposes, and they're being redeployed for AI, and they're relatively inefficient from that perspective. There are smaller startups that have more efficient chip design, but I think there's going to be a lot of innovation that might mean that a bunch of the projections at the kind of extreme are too pessimistic, but there will still be an effect.
Right.
And there should be an effect. I mean, it's an amazing time, in my opinion, to be alive. These tools are getting so much better so quickly that I use them all the time. We use them at Lazard a lot, and I would just, I just rejoice.
One quick word before we wind up. How has it changed work at Lazard?
A lot of the experience of what an analyst and associate does. We have lots of great Columbia and other graduates, really talented people, but as an analyst, a lot of the work hasn't changed that much. You download data from a provider, you put it into a spreadsheet, and then you put it into a slide deck. There can be higher value-added uses of time than that, and so the ability to do much more of that in a automated or quasi-automated way is really helpful. And then for the managing directors who are out with clients, a lot of the wisdom or a lot of the insight is based on their experience, but you can now supplement that with, are there other examples that I haven't thought of that I could cite for this particular case? Or when this happens, how often, so there's all of that. And then there's the back office piece of things, which is truly remarkable in terms of how well these, I'll tell a really quick story, which is we put in a new system at home for our home network. 3 days afterwards, it broke. I was on the phone with the tech support. It was taking forever. I literally just took the entire system log from that system, put it into ChatGPT, said, what's wrong? It found the problem in 30 seconds and fixed it while the tech person on the phone was still telling me what might happen. I said, we fixed the problem.
Right.
That is the future.
The solution to tech support. So,
there we go.
Let me ask you all to join me in thanking Peter Orszag for a great conclusion to this symposium. Thank you.
Thank you.